Hello, welcome to Pensions in 10 with me, David Brooks, and my colleague Andy Knight-Stevens. Okay, this week we take a look at the interest rate cut and the impact on pension schemes and the wider economy. And then we also look across the pond at some Trumpian views on what should be invested in pension schemes. Okay, Andy, first up, there has been the announcement, of course, of the interest rate cut, not rise, as I originally said to you
No,
the other day
definitely
when we
not
were talking about
rise.
this. But yes, so an interest rate cut the other day for the Bank of England. Fill us in. What was the story behind it, and any implications for sort of the wider economy and pension schemes?
Yeah, that's right, Dave. So Bank of England cut interest rates to 4% on the 7th of August. So that was down 0.25% from the previous rate. So that cut, actually, it's quite interesting, takes the base rate to lowest level since March 2023. It was widely expected in financial markets. So that's one piece there. However, what's interesting is the Bank of England, if you look at all the minutes and the notes, they upped their inflation forecast within that. So there was a bit of a warning, or there definitely was a warning and warnings within it on food costs and other items, which could push inflation up to 4% around September. After that, they've got an expectation that inflation will reduce back down towards their 2% target rate. So I quote the MPC, judges that the upside risk around medium-term inflationary pressures have moved slightly higher since May. So that's interesting. Dave, as well, though, September inflation, that's got quite a key timing point, hasn't it?
Yeah, it kicks into lots of areas. So there's sort of two key areas, I suppose. So private pensions, occupational pension schemes, things like that, will often peg their pension increases to that. So that's the statutory minimums, and also many scheme rules have that in any way. So whatever happens next month, we obviously won't know until October when it actually gets published, but we're getting closer now to the actual time when this means something in real life for pension benefits. So if it's looking to be nearer the 4% mark, we're thinking that's the peak. Perhaps in September would be unfortunate timing, perhaps for the cost of pension schemes, but good news for members if their benefits are going to go up a bit more. But also it kicks on into state benefits as well. So we've got the triple lock will still be applying to state pensions. And then we have to also look at earnings. So obviously the 2.5% out the window. It's not going to be that. It's going to be higher than the 2.5 base. But earnings, I think OBR last time I looked had around 4.6% earnings growth expectation. So even though inflation is relatively high compared to 2% target, it's not as high as earnings. So pensioners will probably get that greater of again. So the 4.6% is likely to be what the state pension will increase by in April next year. Obviously, that's the triple locked bit. There is a non-triple locked bit, which is the old state pension, and that will probably go up by inflation, so nearer 4. So yeah, it's getting close to the time when we're actually more worried about it than we normally would be.
Okay, interesting. And then I guess we've got those inflationary worries coming through again, and then there's everyone's talked about it, heard about it. There's definitely economic commentators and people concerned about weak economic growth still out there. One interesting piece around this rate cut, though. So as I said, it was almost a seemingly from the market's perspective, and lots of commentators are saying, it's definitely a guaranteed 25 basis point rate cut. But if you look at the detail, it was actually a very close call and a historic moment because they had to have 2 votes. So it was 4 people on the committee saying no cut at all, which is interesting in itself. 4 people saying the 0.25% cut, please. And 1, this is the external member, Alan Taylor, saying initially a 0.5% cut. So they had to have a second round of voting, at which point they got to 5-4 in favour of the 0.25% cut. So, not a complete 100% vote for that 25 basis cut, and maybe that's why. So if you look at government bond yield curves since, so does this just for our listeners and watchers, it's not the case. It's absolutely not the case that the Bank of England reduces rates by 0.25% and then gilt yield curves just reduced by that same amount. If the market is expecting and it seemingly was expecting, it was reasonably certain that would be the cut, then it could be that the yield curves don't move at all. or not much. And that looks like that happens. So there's hardly any move. If not, gilt yields going slightly higher since then. And perhaps that speaks to the kind of growth and inflationary comments in there. So I thought that was interesting, Dave. I guess we can go further in terms of what does that mean in that cut for DB/DC schemes. So DC schemes, I guess if you're holding, if a member's holding, material cash holdings or money market holdings, perhaps nearer the end of their investment period, you get a low return on cash. Most DC savers and sort of younger DC savers are a long way out from retirement. Those long-term investments, equities, bonds, and DGFs and whatnot, probably just more driven by those long-term returns on those strategies rather than the base rate. So that's not going to alter that trajectory unless there's more broader economic shifts. DB schemes, I guess, if you generalized, a lot of schemes highly hedged and well on in their journey. It might only be a kind of small or modest impact that rate cut. But yeah, it was interesting, especially the vote and the signals on inflation.
Okay, Andy, for our next story, we're going to be looking, we might start over the pond with Donald Trump. And I saw some headlines as I was looking around to see what pension news is around the world. The headline I saw was that Trump is going to allow Bitcoin in 401k. So the 401k is sort of a bit like a SIP, I suppose, for the sake of this 5 minutes we've got. It's like a SIP, but in the US. So what people put their private pensions into. So yeah, so the headline, Bitcoin's allowed in 401ks, got my eyebrows raised, obviously, as I always do when Bitcoin and pensions gets mentioned. But I think you've been taking a bit of a closer look. So there's kind of a bit more to it than that, and perhaps something a bit positive to take from it, even.
Yeah, Dave. So it's interesting. Obviously, the headline will be Trump says 401k plans or maybe like a SIP or DC plan, you can invest in Bitcoin. And then that's the headline. And yeah, look, obviously, it's going to be quite risky for everyone just to put 100% of the 401k plan or their pension savings into Bitcoin. It's a volatile asset. That's the headline. But if you dig under the bonnet, so this executive order from Donald J. Trump has a bit more in it. So it actually chimes or rhymes a bit with what's happening over on our side of the pond in terms of some of this master trust and illiquids or private equity investments and encouragement of. So it's not just digital assets. The executive order that President Trump has said includes private market instruments, direct and indirect as equity debt. There's a lot about real estate being allowed in 401k plans and some in commodities, digital assets, as we've said, and some other infrastructure and longevity type products and investments are going to be allowed. So in effect, he's signing an order that says in these plans, where correct and possible, alternative assets should be allowed people to invest in. And what's quite good, so I look over what's been announced here. Maybe we're going to come on to it on the pensions bill. At least here in this executive order, it talks about possible higher returns, but also it talks about net and risk-adjusted returns. It also talks about some of these alternatives as being good for diversification. Of course, there's the digital asset piece, but I think some of this is quite good. It could open up people to invest in other things that they might want and on their personal circumstances. Obviously, as part of a diversified portfolio, you don't want to go full hog into just perhaps one of these things. But I do compare it, Dave, a bit to what's being said here. And aren't all of these illiquids just going to boost returns? And then figures quoted that it's going to be a magnitude higher than the public market equivalent offerings. At least here it talks about diversification. It doesn't guarantee there will be higher returns. And it says, look, it's for the fiduciaries behind it and it to be able to advise on it and these assets to be appropriate. But look, it does open up those plans to different alternatives.
So does Trump, does he have a mandated power? Is he going to say, we're going to make you do it?
I can't see anything on mandating in there. No. So that's different. That's quite funny. One other thing that's interesting, of course, Trump, my understanding, Trump or the Trump family, they have they have digital asset
Yeah.
involvements, don't they? So
Yeah, there's a cynicism there, I think. Yeah, definitely around the cryptos, the crypto angle, and I
yeah,
think you're talking about what's over here. So we were looking at the pension schemes bill for the definition of the assets, and it's a bit woollier, I would say, in the pension schemes bill. I suspect that will need to be tightened up. I know other commentators in the industry have been calling for that to be tightened up so people actually know what we're talking about. But also, I liked your point you were making there really about how there isn't so much rhetoric around this in America that sort of this is going to be good news for you, and we're getting that a lot from the government that this is a bit of a one-way bet. Making people the modelling has changed over time, but sort of £16,000, £20,000 better off over their lifetime by allocating 10% of the default fund to these private market liquids. And then, of course, we've got, as I asked you, we've got the sword of Damocles, I suppose, or whatever it is, hanging over us of mandating this power to say if you're not doing this, if the providers aren't allocating the default fund in an appropriate way, that they'll make people do it. And the SPP have done a paper talking about this mandation power. I said the word mandation, and I hate that because it's not a real word. But this mandating power to force it in, and they highlighted a number of areas where they're concerned. It's a good paper. Definitely recommend. We'll put a link to it. We definitely recommend reading it. But I'm just looking at some of the highlights of it here. But it's a lot of uncertainty. The impact on pricing. If people are having to go in at a particular time, it's going to have a distorting effect on prices. And the big one for me is this kind of erosion of trust. That if this is going to happen just because the government want it, rather than the fiduciaries making a conscious choice, because we know that
yeah,
liquids are in DC allocations already. We know they have allocation to these kind of assets because they're good diversifiers. They long-term returns, could be better. But if you're this rhetoric, still doesn't feel right to me. I know you read the SPP paper as well. I don't know if you had some other
yeah.
comments.
No, completely echo all of that, David. And
Yeah.
no. Now I've got the sort of Trump executive order to compare. Yeah,
Mm,
maybe it should be more about diversification and potentially higher returns, but
mm,
I'm not sure on the mandation. Yeah, it can create distortions in the market. As you said, what if here, Dave? Right? What if the returns? I know it's not the whole of the portfolio we're talking about in terms of the pensions
mm,
bill and the Mansion House compact. What if the returns don't play out and are not high on the more liquid public market versions? So that
mm,
comes into the paper you referenced. Who's going to pay for that? But I think the trust one is massive, right? Already struggling with adequacy, and some people not even having any pension provision beyond
mm,
perhaps the state. If this then doesn't play out positively with those expected returns, like is being said, does that not take us in a sort of trajectory further away from people trust? People won't trust pensions as much, will they? So
mm.
that's difficult for me.
Yeah. Well, people don't trust politicians. So if your
True.
politicians are making you do something, I think if the industry wants to do this, and there does seem to be a certain amount of support for this. Okay, the industry wants to do it. It's kind of like fine. What can we do? What can you and I do about it? Very little. But I think the part of this journey will need to be this is good for you, and we will protect you, and this does have good value. You're not just paying charges to fund managers or whoever to manage these things. So the governance has to be good. We can't do it on the cheap. No one's asking it to be done on the cheap, I hope. So if the charge is going to be up, then the returns have to be good. These things have to stand up and be run properly. I still sit here as someone who needs to be convinced. I think a little bit. So happy to someone to take me for a coffee or a beer and convince me.
Sure.
Okay.
Yeah, I mean, we can end on a positive note. I'm hopeful it'll be good. It's not the whole part of the portfolio, and yeah, if those returns play out, it could be beneficial for outcomes for members. But yeah, I think we need a bit more granularity there, and we'll see. Okay, thanks all for listening or watching, and Dave will be back with you next week for more Pensions in 10.